Welcome to The Explainer. Today, we're going to build your accounting foundation from absolute zero, so you understand exactly why every single number moves. Look, if you want to master financial modeling, whether we're talking a three-statement model, a discounted cash flow, or a really complex real estate model, you simply cannot skip the basics. Trying to build an advanced model on top of shaky accounting fundamentals is basically a recipe for disaster. So today, we are systematically breaking down exactly how a business records, classifies, and communicates its financial activities. We're going to establish how much cash a business actually has, what it owns, what it owes, and where that money actually goes.
Okay, let's take a super quick look at our roadmap for today. We'll start with 1, the core accounting equation, 2, profit does not equal cash, 3, decoding the income statement, 4, the balance sheet snapshot, 5, tracking the cash flow, and finally 6, connecting the financial statements. Let's dive right in.
Section 1, the core accounting equation. This right here is the undeniable bedrock of all accounting.
So in every single business transaction, there's one universal equation that absolutely must be preserved. Assets equal liabilities plus equity. You have got to memorize this. But more importantly, you need to deeply understand it because getting this right is what prevents those massive, fundamental errors in your future models. Think about it. An asset, that's just something controlled by the business that has economic value, like cash in the bank, raw inventory, or physical land. A liability is a strict obligation, like a bank loan or taxes you owe the government. And equity? Well, that represents the owner's residual interest in the business. Basically, if you take everything the company mathematically owns and subtract everything it owes to outside parties, whatever is left over, the whole shebang, is the equity.
To put that into perspective, imagine a real estate developer borrows 50 crore rupees. Cash goes up as an asset on the left side, right? But simultaneously, debt rises equally as a liability on the right side. That keeps our core equation perfectly balanced. Every time a transaction happens, whether you're paying cash for heavy equipment or covering an employee's salary, this scale has to remain perfectly level. And remember, buying an asset doesn't automatically create an expense. You might just be swapping one asset, like your cash, for another asset, like a brand new piece of equipment.
All right, moving on to Section 2. Profit does not equal cash. Grab a coffee because this is the biggest plot twist in financial modeling.
Generating revenue or recording expenses doesn't necessarily mean cash changed hands immediately. I can't stress this enough. This is one of the most important concepts you will ever learn in accounting. Misunderstanding this one thing is exactly why so many seemingly profitable businesses suddenly go bankrupt out of nowhere. Under the rules of accrual accounting, revenue and expenses are generally recognized when they're earned or incurred, not necessarily when the physical cash hits your bank account. Let's look at a highly practical example of this. Under accrual accounting, if you sell 20 crore rupees worth of apartments, but you only collect 15 crore in cash from your buyers at closing, you now have 5 crore sitting in accounts receivable. What does that mean? It means you formally recognize the revenue. You have that beautiful profit on paper to show your investors, but you don't actually have that full amount of cash in your pocket to spend.
Now, conversely, what if a developer receives 10 crore of construction work from a general contractor but hasn't actually paid the invoice yet? Well, now they have accounts payable. This means a firm expense was recorded, which absolutely reduces your paper profit, but you still kept the actual physical cash inside the business. This specific timing difference between an accounting profit and physical cash is exactly why modeling out working capital is absolutely crucial to getting a business valuation right.
Section 3. Decoding the income statement. Now it's time to decode our performance over a specific period.
Let's track this journey using kind of a waterfall structure. Starting from 100 crore rupee top-line revenue, we are systematically going to subtract costs to arrive at our bottom line. Now, this statement evaluates performance over a period of time, like a full calendar year. You start with revenue, then you subtract the direct cost of goods sold to get your gross profit. Next, we pull out everyday operating expenses, think administrative salaries or marketing, to reach EBITDA. That's earnings before interest, taxes, depreciation, amortization. From there, we subtract non-cash depreciation to get EBIT, pull out the interest we owe the bank to get earnings before tax, and finally we deduct taxes to land at a 5.25 crore rupee net income.
Doing this allows us to evaluate very specific layers of profitability. For example, if you sell 100 units at 100 rupees each and your direct cost is 60 rupees, that leaves you with a really solid 40% gross margin. Understanding these distinct layers is totally key. Your gross margin tells you exactly how efficiently you're producing your core product. Meanwhile, a metric like EBITDA gives us financial analysts a crystal clear view of operating profitability before financing decisions, tax jurisdictions, or non-cash depreciation muddy up the operational waters.
Section 4. The balance sheet snapshot. Notice how the business is split right down the middle here? This perfectly proves our very first equation. Absolutely everything the company owns is funded either by what it owes to others or by the owner's equity. And here's the kicker. Unlike the income statement, which covers an entire period of time like a movie playing out, the balance sheet is frozen. It's a snapshot taken at an exact moment in time, like a photograph taken exactly as of March 31st.
We also have to distinguish between short-term items and long-term items, which really helps us understand the company's liquidity. So on the asset side, you've got current assets, that's your cash, accounts receivable, and inventory, sitting alongside non-current assets, like property, plant, and equipment that just can't be liquidated easily. The liability side perfectly mirrors this with short-term accounts payable versus long-term multi-year debt. And right there, nestled inside equity, is that all-important retained earnings account. That captures all the accumulated historical profits of the business over time.
Okay, Section 5. Tracking the cash flow. We need to answer the ultimate question here. Where did our cash actually go? To find out where the cash went, we categorize activities into 3 very clear buckets. First, operating the business day to day. Second, investing in long-term assets like land or heavy machinery. And third, financing the business through borrowing debt, issuing new shares, or paying dividends to owners. So for instance, if a real estate developer buys an empty plot of land, that is a massive investing cash outflow. But if they secure a loan from a commercial bank to actually build on it, that's a financing cash inflow.
So, how do we find our true operating cash? Well, we typically use what's called the indirect method. We adjust our net income for non-cash expenses, like depreciation, and we account for working capital timing differences. Think back to our earlier rule. Profit does not equal cash. If your accounts receivable increases, it means we recorded revenue but didn't get the cash yet, right? So we have to manually subtract that from net income to find our true cash flow. If accounts payable increases, it means we kept cash we owe to suppliers, so we actually add it back. Section 6. Connecting the financial statements. This is the grand finale, where true financial modeling really begins.
If you memorize this architecture, you'll see how a 10 crore rupee net income boosts retained earnings, while a 2 crore non-cash depreciation is added back to cash flow, perfectly linking all 3 statements together. This is literally the nervous system of financial modeling. The net income from the very bottom of your income statement flows directly into retained earnings on the balance sheet, but it simultaneously jumps over to become the starting line of your cash flow statement. Once you adjust for everything in those 3 buckets we just discussed, the final ending cash balance flows right back up to the top of your balance sheet as your brand new cash asset. It's a perfect closed loop.
Before you go calculating any transaction, run it through these exact debugging questions. This will actively transform you from a passive listener into a true financial analyst. It's really the first rule of modeling. Don't just punch numbers into Excel blindly. Stop and ask yourself, which statement is actually affected here? Are these specific accounts increasing or decreasing? Is this a cash or a non-cash item? Does it impact my reported profit and equity? And most importantly, does the accounting equation still balance? Using this structured thought process is the ultimate secret to debugging even the most complicated models without getting totally lost.
Okay, I'm going to leave you with this final real estate challenge to test your accrual accounting skills. Solve this mystery and you'll know your accounting mechanics are rock solid. If customers book 100 crore rupees of apartments, but only 60 crore is actually collected in cash, is the developer's revenue 60 crore or 100 crore? And why? Remember the principles we've covered today regarding when revenue is actually recognized versus when the cash formally changes hands. Think deeply about how this exact scenario flows through accounts receivable, the income statement, and ultimately the cash flow statement. Get this right and you are officially ready to tackle the big leagues of financial modeling. Keep exploring, keep practicing, and actively apply these fundamentals to every single number you see.